tuning in. My name is Santiago here with Grapevine Trading. I wanted to go ahead and make a quick video. This one, I wanted to focus on the basics of options. I know some of my viewers and my subscribers don't know exactly what options really is, so I wanted to go ahead and take this time and describe the basics, the terminology of it all. Also, I wanted to go ahead and focus on my style of trading when it comes down to options, and I wanted to break down 2 plays that I made earlier this week as well. Alright, so without further ado, let's get right to it. What's going on, guys? Thanks so much for tuning in. If that's your first time, please hit the subscribe button, click the like button. If you're joining us again for the second or third time or fourth time, I want to go ahead and say thank you once again for watching. So like I said, I wanted to go ahead and make this video pretty much focusing in on the basics of options and options trading. So I wanted to go ahead and first break down what is an actual option. So by definition, an option gives the option holder the right but not the obligation to buy or sell an underlying stock at a set price, which is the strike price, which we'll get into later on, by a set date, which is the expiration date, which we'll also get into at a later date. So pretty much the option contract allows you to profit if a stock moves in your favor before the contract actually expires. So if you think that a particular stock like the S&P 500 ETF, which has options, at this low point of around the 234 area, if you believe that it was going to continue up and make this bounce, then you would buy a call, right? So a call is a contract that appreciates when the underlying stock rises. So you would buy a call when you're actually bullish on the company, right? Now, if at this peak of around 280, you believe that the S&P 500 was going to decrease in value, that means it's going to continue selling off, then you would buy a put option. And when you buy a put, pretty much means that you're expecting the underlying stock, or you're expecting the actual company to decrease in value, to sell off. So a put actually appreciates in value when the underlying stock declines. So like I said before, if you are bearish on a particular stock or company, then you would buy a put. Alright, now not all stocks have options, only those with enough interest and volume. So like I was saying, not all stocks actually have options, just the ones with the highest interest and the highest volume have the options contracts, and you're able to trade options on them. So what's very important, of course, is for the volume to actually be high, because you want to be able to sell these contracts. So what a lot of people don't understand is when you're selling a contract, has to be someone on the other end buying it. So whenever there's a transaction, there's always a buyer and there's always a seller. If the volume or the interest is not high enough and the liquidity is not actually there for you to sell or buy the particular option, then you're not going to be able to get rid of the option when you want to sell it. So that's a very important concept to actually keep in mind. Okay, so we talked about calls, we talked about puts. So what I wanted to go ahead and talk about was buying calls. So like I mentioned, if you want to buy a call, that's only if you're bullish on the actual stock. So if you think the stock is going to be going up, that's when you would buy a call. Each option represents 100 shares. So if I were to go into the trade grid here for the options chain for the S&P 500, you would see that every option, let me just make this a little bit smaller for you. You would see that every option here has a bid and an ask of about $4 to 70 cents. Now, due to the fact that a contract represents 100 shares of an actual stock, this price, since it's at $2.28, you'd have to multiply that by the 100 shares that you're controlling. So all in all, you would be paying $228 for this particular options contract. Okay? Same goes for this option contract right down here that expires on January 11th. and that's going to be 79 cents. You multiply that by the 100 shares that you're controlling, so all in all you would be paying $79. So because you're controlling 100 shares of a stock, an investor can control and benefit from many shares of the stock without putting a lot of capital at risk. So instead of buying 100 shares of the ETF, the S&P 500 ETF, you can just buy the contract and you wouldn't be putting up too much capital up front. Now another focus that I wanted to mention was strike price. So the strike price is all of the numbers that you see here. Now these are numbers that are relative to where the actual stock is trading. Now I wanted to go ahead and focus on a company that a lot of people are aware of, so I wanted to go ahead and focus on Apple as opposed to the S&P 500. So as of right now, this yellow number indicates the price that Apple is trading at, which is around $153.31. The strike price, by definition, the strike price of an options contract is the price at which an underlying stock can be bought or sold. It's the price that the stock must go above for calls, if you're bullish, or go below for puts, if you're bearish, before a position can be exercised for profit. So essentially, if I think that Apple is going to increase in price from this 153 area up to around the 160 area, I would be able to buy this call for $11 because I'm multiplying this by 100. I would buy this call for $1100, and as the price increases towards that 160 area, this contract is going to become more expensive. So I'm going to be profiting on that actual contract. Now another concept that's very important is the expiration date. So every date that you see here, January 11th, January 18th, January 25th, February 1st, February 8th, are going to be expiration dates. For most contracts, for most companies that actually have option contracts, the expiration date is going to be on every single Friday. So in particular, this Friday is January 11th, January 18th, 25th, the 1st, the 8th of February, 15th, and it goes so on. So the expiration date is very important because it is the precise date that the option contract actually terminates. So pretty much I want Apple to be going towards that $160 strike price, towards that $160 area before January 11th. If the actual price of the underlying stock, in this case Apple, does not reach 160 or above, then my contract is actually worthless. Options contract can be in the money or it can be out of the money. So if for call options, we'll just focus on call options for right now. The option is going to be in the money if the share price is above the strike price. The option is going to be out of the money if the share price is below the strike price. So one way to focus on calls and puts is call up and put down. So if you're buying a call, that means you want the price of a particular company to increase in value. Alright, so now for put options, the option is in the money if the share price is below the strike price. The option is out of the money if the share price is above the strike price. And again, I wanted to go ahead and reiterate. If by the date of expiration, your options contract, whether it's a call or a put, is out of the money, that means it's going to expire worthless. So if I were to spend $390 on this particular contract and it doesn't hit my strike price by that point, then this will be $0 by January 11th. That's why you can see that all of these particular contracts that are out of the money are decreasing in value because this 170 strike price is $17 away from the actual price that it's at right now. So that means that Apple has to move $17 in a matter of pretty much 1 day in order for this to be in the money, which is extremely unlikely. That's why it's most likely going to expire worthless by January 11th. Okay? So pretty much in conclusion, in terms of valuing options contracts, it's essentially all about determining the probabilities of future price events. So the more likely something is to occur, the more expensive an option would be. So I also wanted to go ahead and take this time and break down just one trade in particular that I made last week. And this was a trade on Apple. So we had the huge sell-off in the market where we had about 11 to 12 red days. And I saw that Apple had increased, it had bounced a little bit, and what I really saw was the 180-day 4-hour chart. I saw a lot of consolidation here around the 158 level. So it bounced, but it had a hard time really getting above that 160 area. So I decided on the 27th, which is around this day right here, to buy a put on Apple. And what I did actually was I bought a put spread. So I bought the $155 put and I sold the $150 put. Spreads is going to be a strategy that I will explain in one of the later videos, but essentially I want to show here the order confirmation, and what it was I got filled on December 27th for $180 for buying this put debit spread, which, like I said, I bought the 155 strike price Apple put and I sold a $150 strike price put. So all in all, I bought it for $180 and I ended up selling it right up here on January 4th for $495. So right around this day was when they actually came out with news that their revenue was actually less than expected. So it tanked from the 156 area all the way down to the 142 area. So I ended up getting filled on January 4th, and the contract that I actually bought for $180, I sold for $495. So I'll do the math in just a little bit, but I ended up selling it not on the 3rd, which I could have made some really good profit on, but I thought it was going to continue going a little bit lower, but it's actually bounced and it's made a nice little bull run. But I ended up selling right in here in this day, which is January 4th. So I paid $180 for it and I sold it for $495. So it was a $315 profit there with only an initial investment of $180. What I focus on really is not taking too much risk. So I don't trade more than $200, maybe $300 per contract, per spread. And that's just because if I were to lose 100% of it, then I lose, $200 to $300, and I can accept that. But if I were to be taking positions that were $1,000 to $2,000 and I lose all of that, then that would be a detrimental hit to my account. So as of right now, I'm just focusing on small gains. I'm not really focusing on the big home run gains. So that ties it up for today. I really hope you guys enjoyed the video. I try to make it as quick as possible, but a lot of information here. If you have any questions, please leave them below in the comments. Please click the like and subscribe button as well. First of all, I want to go ahead and thank all of you guys for tuning in and for watching my videos. I'll definitely be coming out with some more content for you all to enjoy. Also, Happy New Year. 2019 is going to be a great year for Grapevine trading, and I know it. Hope you guys are all having a killer year as well.